Good morning, TradeStation Nation, and welcome to our Tuesday morning market briefing. It is November 7th, 2017. I'm Don Prattle, your Director of Trader Development and Education here at TradeStation. Today, our presenter is Mr. Corey Rosenbloom. A couple of pieces of news today. Top ECB officials, including ECB President Mario Draghi, will be speaking at a banking supervision conference in Frankfurt. We'll be looking for news from that event. Turkey's Prime Minister Binali Yildirim visits U.S. today. The president is not here to greet him. The Mercury Systems is going to meet with investors today. Microsoft's next video game console goes on sale for $499. An FDA advisory committee looks at Pfizer's investigational vaccine against staph infections, and Metropolitan Bank Holding is set to price 3 million shares at an average of $32.50 each. The crackdown on corruption in Saudi Arabia has put $33 billion of personal wealth at risk, with Prince Al-Wahid bin Talal losing more than $1 billion after shares in his Kingdom holding company plunged following his arrest. President Trump appeared to be front-running his foreign policy planners when he tweeted a positive response to the shakeup in Saudi Arabia. Oil remains near the highest level in the past 2 years following the stunning weekend events in OPEC's biggest oil exporter. Overnight, the markets were higher around the globe. The MS Asia Pacific Index gained almost 8%, while Japan's Nikkei 225 stock average rallied 1.7% to reach its highest close since 1992. The S&P futures, the S&P 500 futures, were unchanged, and the 10-year Treasury yield was 2.333%. Gold slipped in value overnight. The Asia Pacific Index was gained only 0.8%, not 8%. The president is in South Korea for a 2-day visit that will feature talks on a trade deal with that country. He said the president, at any rate, coordinating a regional response to the North Korean situation is also on the agenda. There's a number of challenges that the U.S. is navigating, and they are very important to us. Back at home in Washington, the House Tax Writing Committee began a 4-day debate yesterday to hammer out the details of the Republican tax plan. The Ways and Means Chairman Kevin Brady of Texas said he'll follow what the various revisions in committee will take place, but not on the House floor. The goal is to have the proposal in the House by the end of the week. All right, everybody, that's enough from me. Our presentation is for educational purposes. All the symbols and all the trading ideas that we're going to discuss here are for demonstration purposes. They're not recommendations, and our presentation is not an offer or a solicitation of any kind anyplace where we are not authorized to do business. Active trading is not suitable for all traders or all investors, and options trading carries a high degree of risk and is not suitable for all traders. Please take a look at the disclosure information and the handouts made available in the chat panel regarding the various asset classes here at TradeStation. And these documents are also available on the TradeStation website. Our presenter today, Mr. Corey Rosenbloom, fresh back from the Money Show in Las Vegas. He is a CMT, a trader, educator, and an analyst, and his goal is to help us all and create a community dedicated to reaching out to those who've been burned by the market. Put your hands up if you've been burned by the market once or twice. But if you're anxious about risking money to make money in the stock market, Corey will absolutely be able to assist you. He's been investing for at least the last decade, and he trades quite actively, and he's got a very interesting and innovative practice. I want to turn things over to him this morning for the morning market briefing.
All right. Thank you, John. Good morning. This is MG and Tom, Susan. good friend Vaughn, Dwight, Bruce, and Spiros. Good morning. Greetings to you from an unseasonably chilly Los Angeles, California. Usually sunny here, but it's cold. It's coming into the winter time here. All right, good. I got to see Don and some other people at TradeStation at the Las Vegas Traders Expo. And I was curious. Don mentioned who's been burned by the market. And I had a 4-hour session. I taught a class on swing trading and then a class on trend trading. And so I was just curious. I asked both audiences, who's loving this bull market? You can see here on the right side of the chart. Just ask both, who's loving this? Who's making money, hand over fist, just happy? I think 10% raised their hand. 10%. Everybody else was like, oh, it's disgusting. Oh, you just want pullback, etc. I have those same sentiments. This market just won't pull back. And then, oh, cool. Yeah, Tom. Thank you, Tom. Yeah, I did a little in terms of Tom as one of my members, and for a long time now. And I just had it's observations, and that's what I was talking about for members. And I just had to jump in there, but we offer you a free 2-week trial. You can see what I said about the questions I had and sort of the colleague conversations I had. I just put like a 2-page thought idea, but that's there for you in the membership report. That's a free trial there in the chat box. But I was just curious about that, and just as I asked questions and got people's thoughts from the colleague section to the general traders, experienced traders, and brand new traders. There was only one. I asked in the trend day session. I was talking about Amazon and its $80 gap, and only one person said that she was specifically trading that long. And in terms of both audiences, one person got that big 80-point move. Nobody said they were on the wrong side of it, so that was good. Yeah, good to see you, JH. I missed y'all too. It's good to be back at TradeStation here. It's kind of cool. That's why I like the live, and Don can attest to it as well. When you meet traders face to face, we do this because we love this. Trading is fun, trading is enjoyable, but it can be isolating. And so traders expos or meetup groups or different places you can go to speak to other traders, that's a lot of fun. And so it just keeps us motivated and fresh and gives ideas and lets us hear from other people, other perspectives that we might not be looking at. And so I'll sort of continue to discuss those points of views. But let's go ahead and jump in the market here. This is potentially or part of why traders are just not loving the market. You would think from an outsider perspective that this little chart right here would make all of us happy, making money hand over fist and just getting long and holding long and all that. Well, that's obviously maybe some of us are feeling that way. Yeah, Vegas. Yeah, that's true. Yeah, it's weird to be back after the incident in Vegas. It's a different feel of the city, but it's Vegas is strong, so it's recovering there. We were over at the Paris and Bally's resorts, but it's just difficult to get a structure. If you go back in time a little bit, this is with the exception of 2013 right here. So just keep in mind, if you're a new trader at this is a special environment. If you're a long-term trader, and I've been 18 years at this, since 1999 when I got started investing and swing trading in 2003 and day trading from 2007 forward. This is a unique event, 2013 to 2015. It's this low volatility creep. You got higher volatility at the ending of it, but it's still led to this ongoing bull rally. And that's what's happening now. So from 2016, January, February, March, you had the low, and from that point, this is the election, at this point, November 2016, but the market was up all year after an ABC pullback into 2016. To an extent, TJ, yeah, to an extent, the going thesis, by the way, also when I teach, I've got teaching on the mind right now, but I do a lot of different presentations in different groups, obviously beyond Afraid to Trade. And I always discuss the narrative, and the membership we do it too, the broader narrative. And so in 2013, we had a handle on this. We had a simple little narrative that talked about it. If anybody remembers what it was QE, QE3. So that essentially was the Federal Reserve buying up assets and printing money, and the quantitative easing part 3, which is after a twist. And so the Federal Reserve was aggressively boosting up the stock market via those methods. And so we had QE1, which is a straight up rally, QE2, straight up rally. twist, kind of flatlined and went up, and then QE3, or other people called it QE Unlimited, we'll print as much money as we need, and that's Bernanke, and that was a simple. Those lots of other moving parts, but that was your broader narrative. Quantitative easing, the Fed's printing out money, buying the bonds, boosting asset prices, and that was logical. What's logical now? If you're looking at GDP, that's good. Unemployment, that's good. So the economic factors are strong, getting stronger. So that's fine. But even in that scenario, you don't see this level of bullishness and optimism and straight up action. GDP at 3%, unemployment about 4.1%. That's great. We've been on these pathways and trajectories for a while, the jobs rate, etc. So that's not going to be the reason for why the market's straight up. I think TJ kind of nailed it there. It's not so much Trump, it's the Republican Congress and the expectation for what we're seeing now and what Don did a good job of updating us on, which is the tax reform and how that goes through the House committees and eventually the Senate committees and etc. And the need, I really think that healthcare, I was a little bit, is it going to work, is it not? And healthcare wound up not passing, or the repeal of healthcare, or repeal or replace. But I think that this tax plan in some form is going to go through. It's going to go through and be passed there. And so, right, this is the narrative. So we're talking narrative beyond just the day session. But why is this happening? It's in part because of Republicans typically, when in Congress, will push for lower regulation. And lower regulation means businesses spend less money on lawyers and policies, and their bottom line, their earnings tend to go up. With less regulation, earnings tend to go higher. And of course, earnings go up, stock prices go up. So that's factor one. Factor two is going to be, right, the tax policy. So cutting corporate taxes leads to increased corporate profits, one would think, and obviously increased earnings per share and higher equity prices for their stocks. But also tax cuts to the middle class and other wealthy investors, wealthy individuals, that puts money back in the economy. So bigger economic spending leads to bigger corporate profits. Bigger corporate profits leads to bigger stock prices. So that's the going thesis. By the way, this is why it's important to get the narrative. The narrative in QE is that the government's printing money, and that's what's helpful in that sense. If this is all based on future projections, which of course it is, if the tax plan does not go through, if you see a month from now and the goal is to get it passed, I think, by Thanksgiving. If not that, then before Christmas, give a good old little holiday break there, and if not that, then into January. But if you start to see the tax plan, which the news and headlines are positive in terms of getting passed, if the news and headlines start to shift that, oh, the Republicans can't get this, or this faction of the wing or is not working out, or not going to pass this, or it's too expensive, or doesn't cut taxes enough, etc., that's when you'll see the market, if this is up due to the Republican regulation and tax policy in the future, if that doesn't happen, you probably will see, how do I say it nicely, removal of risk appetite from the market. It would be a market crash. Anyway, David asks, what about the U.S. as a payback for QE manipulation, if ever? We're going to have a new Fed chief, so I don't mean to go too much into. Well, I do. This is the briefing, so this is narrative. So this is beyond this session. This goes to the narrative, why things are happening, what money flows are in general. So quantitative easing is essentially it's the buying of assets, buying of particularly treasury bonds from funds, not from the government. Government doesn't buy from government. It buys from funds, etc. And they buy treasuries. They take on treasury assets into the Federal Reserve balance sheet. They do it through, it's not so much the printing of money, it's through electronic transfer. And so it is increasing, it's not so much increasing money supply or flow, but it is just basically taking away from banks and services their treasury positions and putting it on the balance sheet of the Federal Reserve. And so they hold at this point somewhere in the neighborhood of $4.7 trillion of assets, particularly in mortgage-backed securities and in U.S. treasuries. So the process or thought process or the arguments in the Fed, Chair Yellen, et cetera, is we're going to unload the balance sheet. We're going to unwind the balance sheet. And that is either done by letting assets expire. So treasuries have a fixed shelf life, shorter term assets, 1 year, 5 year, 10 year, etc. So letting them go off the balance sheet by maturity, and they pay back the federal government through the proceeds and the dividends and interest. But anyway, so that's either unwound just by that or by selling out the treasuries into the market. And so that, we haven't quite seen that happen because guess what? We've not really seen this level of QE processes or activities from the Federal Reserve. So how does it happen? What do we know? We don't know. But the general process or general thought is that it should have some type of depressive effect on the, we'll see. I don't want to make a forecast on that necessarily, but we'll see. We haven't seen it happen. We'll see. Trump's favorite little thing. Yeah, the primary dealer banks are paid by the Fed for selling. So yeah, I'm curious to see how this is going to work out. I've not done a whole lot of research on that end, on the back, behind the scenes processes on how the Fed unwinds. It made sense. We had many, many years and many examples of what happens during a QE purchasing cycle. And so this is QE1, essentially. It started kind of over here, but QE1 and the end of QE1 led to a sell-off. And then QE2, the expectation actually started over here. QE2, it was ended in 6 months and then down. And then twist happened over here. And then from that point, QE3 began in earnest and then ended. So anyway, yeah, there is a positive correlation with asset prices and QE. Yeah, exactly. It just, the U.S. has less buying power and market prices inflated. So the correction unwinding. Yeah, we'll see. I could spend all day talking Fed policy, but we're here for dark briefing. Okay, so fun. All right, so where are we? We're just overextended, overbought. Same thing. That's again why people, 10% were like, I love this market, and 90%, myself included, were like, this is unusual. Yes, it's unusual, but it's the market that we have. And so two things before we jump into the, intermarket analysis. I don't know exactly on a resource I could, there's lots of places, Bloomberg, just look at different ways to TradeStation. I do a correlational studies, which is TradeStation. And I obviously look at, for my members reports, the question was on intermarket correlation. I'm looking at money flow between markets. So I'm just doing this on the active basis, but just for reference, treasuries and jump over here, treasuries and gold, just think about these things, are strongly positively correlated, at least at the moment. So gold goes down, a V-spike reversal on the 27th, gold goes up, not as much, and treasuries go up. But usually you see treasuries compete and gold and risk-off markets compete for investor money. And so if gold's going to bottom and trade up, and treasuries are going to bottom and trade up, you would think stocks would top and trade down. Not the case. Oil is, as Don mentioned, in part because of the Saudi Arabia, this corruption and arrest and other little points with an OPEC, big OPEC country. And so the uncertainty in what that means and what's going to change is going to shoot the price of oil in terms of a risk. It's a lot of risk coming in the market, or coming in the commodity, that's going to shoot the price much higher. And that's what's happening. It's not so much technical analysis, it's uncertainty in terms of corruption and arrest in the palace and palace intrigue, we'll put it that way. We'll come back to this in a moment. So how do you trade these things? Two statements, which I always tend to make. Saudis are slippery when it comes to oil. Two statements. I wanted to make a point to readdress or address. Statement one, trends once established have greater odds of continuing than of reversing. It's Dow forward. Dow from Elliott to Schabacker and Wyckoff and Pring, Murphy, Rashke, etc. Anybody who really does public analysis or public education, that's what they always tend to come back to. Trends once established have greater odds of continuing than of reversing. All right, so that's pretty clear there. But if, statement two, if something should happen but does not happen, it often leads to a bigger than expected move in the opposite direction. And what we're asking for is not a market crash. Don't want that. Don't really want that to happen at all. We would like a normal pullback. We'd like a normal swing. That's all we're asking for, Mr. Market, like this in terms of 2017. We would like the market to make higher highs, higher lows, higher highs, higher lows, pull back, some percentage of that, higher highs, higher lows. I know, right? If anybody's heard my presentation, that's exactly what I say, because it matters. If something should happen but doesn't, it often is a bigger than expected move in the other direction. Yeah, that's my little epitaph there. Yeah, exactly, TJ. Yeah, not much, not much. And we're not asking for a whole lot here, Mr. Market. So when this thing happened right there, this is what I do in my membership as well, and planning in my strategies. This is swing trading logic. Also works intraday too, as we're game planning out today and forward. Just look at precedent. So precedent here, it's going kind of quickly at the 66 point move. That's almost a 50 S&P point move. That is about a 44, and that is about a 60. So going into 2017, you had 4 pullbacks. And so you're going over here, average that out, maybe 50, and you're like, okay, let's pull back 50 points. That's asking it to go to about 2460 right here. So when the market didn't do that, when the pullback didn't happen, because that's not a pullback, that's a, take a breath, that's a sneeze, market sneeze right there at 2500. The next result was not this kind of stable up. It was a rip your head off, rip your complete positions off, and just embarrass you and mock you endlessly, because people were short, people were hedged, people used sort of protection in terms of puts or calls or option plans, or shorting ETFs or buying inverse ETFs, whatever the case may be. That was a logical expectation for the market to go down 50 points. JH says, that's asking too much. Yeah, certainly was. Goodness. All you pulled back was 16. Yeah, exactly. Markets are designed to trick the most people, trick the majority of the people the majority of the time. So just keep this in mind. If you're new or intermediate, whatever the case is, again, my goal is to help people burned, to help people that are hurt or all that kind of thing from the market. And this is why most people, even if you're logical, you don't need complex technical analysis that says, well, the market's overbought, going to go down. It doesn't matter what you're using. Fibonacci, Elliott, Gann, name it, divergences, Bollingers, etc., trend lines, linear regression, you name it, and it's going to tell you the market's going to probably pull back. And so what happened was not the pullback. And so what happened next was this massive stop loss run. So those that were short, logically speaking, and should have been from complex and simple methods, had to bail. And those that were long, this is why we don't like the bull market. If you're new, again, people are like, why don't you like the bull market? Here's why. Because when you want to be a buyer, if you assume trend continuity, and if you're even correct that the market is going to go higher and the trend's going to continue, you typically do so or engage the market on pullbacks, on retracements, like these little things over here. So it gives you what we call structure. Structure being, forget the price level, but just, again, a little trend line here. It just indicates to us that there is a normalistic or structural behavior to price, right? So it goes up, hits the upper level, pulls back, up and then back, up then back, up and then whoops, right? So anyway, we don't like it as buyers, even if you're right on the fact that the economy is going, this tax cut policy, GDP, even if you're correct about all that stuff, you want to buy on pullbacks. But this didn't pull back, so what winds up happening, just begin to reference, I think I'm doing more teachy today than forecasty, but I think it's important to reference and learn. So even if you're bullish, even if you've got everything going right, you think the market's going to go up, you feel very, very uncomfortable and very weird buying this kind of behavior. It just doesn't feel right because that's not usually what the market does. So even if you're going to be correct, you kind of almost close your eyes and hit that little buy button or hit that bracket order and TradeStation there. And that's just not how you trade, not exactly how you do it in a risk-controlled environment. Oh, it's a new high? Get long. That's typically not how the game is played. It's played on pullbacks. It's played with risk, with stops, and trail the stop, and et cetera. Buy the flag, get in on the breakout of a trend line, or pull back to a Fibonacci, or pull back to a trend line, pull back to a moving average. That's how the game is typically played, and that's not what happened. So yeah, structure tends to be more so. Structure refers to, by the way, structure refers to the highs and lows So higher high, higher low, higher high, higher low, etc. And that tends to be what we classify waves, swing structure. Higher highs, higher lows make an uptrend. Lower lows, lower high make a structural downtrend. And then equal or same highs and lows make a sideways trend. So when you did not get a structural move, the next thing that happened was just this, what we call emotional movement. Yeah, and that too, traders are tired about hearing about all the money. And it's what's weird. And again, at the Traders Expo with other colleagues that I talk to behind the scenes, I'm not, intraday basis maybe, but I'm not seeing people knock it out of the park in terms of this. Again, if you're new, you're like, you must be making a bunch of money. S&P's and all. We're being cautious in a sense because this market could fall apart quickly. And also just that we don't really have this, I don't have this great grand narrative explanation for why the market's doing this, why it's going straight up, why it's not pulling back. GDP and tax policy, that's what's being billed as the reasons, but I don't know, it's just one of these, it is what it is. Well, that's, yeah, TJ, yeah, odds favor, right, in terms of, if you can see the chat, TJ says the S&P trading range is most likely next. Yeah. So what tends to happen when the market does these behaviors, it's technical analysis 101. Trends tend to continue, but one other component of the technical analysis model is that price alternates between range expansion and range contraction. So even these little pullbacks, range expansion is a movement higher or lower, and you get sideways consolidation. Market digests the move and then impulses back up, consolidates. That's how the markets behave. So really all you've got at this point is the trend continuity principle. That trends once established have greater odds to continue than reverse. Yeah, I listened to another colleague do a presentation on chasing performance, and it's just money managers, and they're not, I don't think they're necessarily happy too. When the markets do this, it creates frenzy. It creates people excited and emotional. And so maybe they've been conservative or holding back, and so they'll call their broker. They'll hear on the the water cooler at work, oh, I'm making a bunch of money. I'm long Amazon. I'm long Netflix, and I'm here in LA, my friends. I'm long Bitcoin. So I hear that, and so what happens is people, they get FOMO, fear of missing out, and they call their broker. This is people that are average individuals that don't trade. They just have money, and they're average people in the society. So they call their broker up and say, get me long. Here's $10,000 or here's $50,000 I've been sitting on. And so this behavior is to an extent emotional, even irrational. Again, if you're a trader, this stuff, you don't do this. If you're an individual who doesn't look at markets, you see it up, you're missing out, so you just capitulate and you jump in the market. And so when you call your financial advisor, he or she buys the stock market, or they spread your stuff out on index funds, etc. So yeah, exactly. So yeah, it's just chasing performance. And also, if you're Bitcoin, and if you're a run-of-the-mill money manager and you've been conservative and your portfolio is lagging behind the market, which a lot of people I expect are run-of-the-mill fundamental or financial advisors, investment portfolio managers, you've got to chase. And if you end your 2017 down, you might lose clients, and if you lose enough clients, you might lose your job. And so these people are like, screw it, I'm just getting long. And that's all this is contributing to this behavior. So again, I think it's kind of more introspective, or we didn't cover a bunch of stocks in today's session, but I hope that I gave you some things to think about, because the narrative matters. If you get the narrative wrong, if your narrative is, this market's overdone, it's going to pull back. This market's too high, it's going to reverse. Well, that's incorrect. It's not. At least it will in the future, but that's not the correct way to assess what's happening. So if you are shorting this market, in a normal environment, that's what you would do, to be cautious, be conservative, etc. But it's just jumping away. Market philosophy of Corey. Trader Psychology Tuesday. But real quick, let me just, before we jump, we got 1 minute here. I'll just kind of look at your markets here. Do this if you're on your own time. Look at individual components in the Dow. So obviously Apple, Boeing, Caterpillar, strong ups. Home Depot, GE, stocks actually can go down, all right? GE is pretty nasty. Intel's big up there. JP Morgan, and McDonald's, Triple M, Look at Merck. It had a little collapse there. Microsoft, you're seeing movement with Tech, UNH, Walmart, Visa, and American Express. These are your bullish names. Strong stocks getting stronger, and then weak stocks get weaker. So anyway, yeah. Again, we're here to have fun. Thank you, Serge. Awesome. It's cool. Thanks, Tom. Take care. Be safe in this environment, and trends continue. And if you don't get a pullback, you get a bigger move up, which is what we're having. All right, we'll turn back to Don. Be safe, and I'll see you all soon.